Alright, hello everybody. Now I wanted to do a quick video on risk. Now rather than talk to you about exactly where to set a stop loss, figuring out support resistance levels or risk to reward ratios, what I wanted to break the risk down into its philosophical issues and the way that you need to think about risk in trading, because unless you're thinking about risk in the correct way, then you can't develop the correct places to put these stop losses or understand why they should be put where they are. And if you followed my ranting on Reddit and different topics, you'll see that I have two particularly common phrases that I'll use regarding risk. One is that you can't risk too much, but you can risk one is that you can risk too much, but you can never risk too little. The second one is take care of the downside and the upside will take care of itself. So to look at the first one, you can take too much risk, but you can never take too little risk. Whatever you lose, you then have to make back to get back to your base point. No great insight into that, except when you start to think about how the maths works, because the more you lose, the more you have to make back, and even the more you have to make back. What do I mean by that? I've done up this spreadsheet. This column is the amount that we've lost, and this middle column is the amount that's left in our account. So it starts at 1, goes to 100, starts at 99 and goes to dead. The third column is the amount that we have to win back to get back to our base point. So, for example, if we lose 1%, we have to gain back very, very slightly over 1%. We lose 10%, we have to make back 11% to get back to the 100%. We lose 20%, we have to make back 25%, etc., etc. We get down to 50, we lose half our money, we have to double the amount that we have to get back to our base. So I've graphed it. On the right over here, I've gone from 0 to fully lost, and you can see the orange line is the amount we've lost, and the blue line is the amount we have to gain to get back to base. And as we go further along and we lose more and more, it takes off like a rocket. So 50% is big, 75% is even bigger. You lose 90% and there's no coming back. You lose 95% and you have to gain 19 times your starting position just to get back to 0. So it's really important not to lose too much money because it's too hard to recover. Now on the left hand side, instead of going from 0 to 100, I've just gone from 0 to 50 so that you can see how these two lines pan out from each other. I always say the magical number is 20, because you can see at 20 the lines are starting to diverge, but it's not getting up to a ridiculous amount. By the time we're up to 50, it's really starting to flare out, and even by the time we get to 25, it's starting to flare out. So the difference between 15 and 20 is under 8. The difference between 20 and 25 is over 8. 25 and 30 is becoming close to 10. So you can see that it fans out very quickly. So we want to keep these two close together. Therefore, I always say do not draw your account down any more than 20%. That's the maximum that you should be having to draw down, because if you draw down 20%, you only have to gain 25% back, which isn't too much more than what you've already lost. So don't risk too much per trade. Now, the second advantage of that is that when you risk smaller amounts, this is the can't risk too little idea. When you risk smaller amounts, you're pressure decreases. You can work your system better. You can let your winners run, and you can cut your losses. You're not thinking, oh my god, if I close this trade here, I'm going to lose 10, 20, 30% of my account. I'm just going to hope that it comes back. And you ignore whatever plan that you had for your trades at the start, and now you're just praying to the great gods of the market that it's all just not going to go terribly pear-shaped. So too much risk just broke your rules. You're never going to break your rules on too little risk. You're going to be able to stick to them comfortably. You're going to be like, oh, whatever, I lost 0.5% in my trade because it went wrong. That happens. I expect to have losers. No big drama. Next time I'll go better. Alternatively, if you're risking a lot and the trade goes in your favor, you think, oh, I've got 10%, 20% profit just sitting on the table. I'm really worried that it's going to reverse and go negative, and I'm going to miss out on that money that I've made. So you shut the trade, and then you see that according to your system, the trend runs on, and you could have made 5, 6, 10 times the amount of profit if you'd let it run. But you cut it short because you were afraid it was going to reverse. You wanted the money that was on the table. So to keep to your system, you need to risk an amount that's comfortable. And the smaller the amount, the more comfortable it will be. So the other thing as well to remember is, no matter how well your system, you've back tested it, when it comes to live trading and there's real money on the line, things become different in your head. For example, a 50% win system is almost guaranteed a minimum of 5 losses in a row if you trade it 100 times. So you are for sure going to get at least 5 losses in a row on a 50-50 system. And by 50-50 system, I don't even mean 50% win, 50% loss necessarily, but let's say you taking into account your risk to return ratio. Actually, forget that, it's getting complicated, but this point stands in its essence. So if you're going to get 5 losses in a row and you're risking 5% per trade, then over the course of 100 trades, you're almost guaranteed a maximum of 25% drawdown. It could be more. You could be unlucky and you could get a run of 8. Or you might be lucky and get a run of 3, but chances are 100% that you're likely to get 5 in a row. So we want to keep it under 20, and we know that you're almost guaranteed to get a 5 times losses in a row over 100. So even 5% per trade ends up putting pressure on your system pretty quickly. Because if you got 5%, a 25% drawdown after 5 losses, you're going to start freaking out about your system. You might have back tested it and know that occasionally it goes through bad runs, but all of a sudden you're thinking, hang on, this is all going bad, my system isn't working. You throw the baby out with the bathwater, when in fact these things happen, statistics happen, bad runs happen. So you have to be prepared for the bad runs, which brings me to my next point. You need to worry about the downside and let the upside take care of itself. So what does that even mean? The whole point of trading, people say, is to make money. And it's heaps more fun to think about winning than losing, because winning's what we're here for. But is it really? I would say what we're here for is to be here tomorrow. So I would rather than thinking about the winning, thinking about trading like crossing a road, where reaching the other side of the road is like your profit. When crossing the road, should you be in a rush to get to the other side? Should you just be solely focused on the other side of the road? No, the object of crossing a road is more than just getting to the other side. It's getting there safely. Dogs don't think about the risk. They just want to get to the other side, and they get hit by cars. So humans will pick the moment to cross where it's the safest. You'll stand and you'll look both ways. You'll listen for cars, because you mightn't be able to see around a corner. So you know that you need to pay special attention to the right-hand side coming around the corner. So you listen for the car. How fast are these cars going on the road? Do you see a car coming really quickly down the road? How many lanes of traffic are there? What are you wearing on your feet? Do you have thongs on and that you're going to trip over, so you need to be more careful and allow yourself more room? There's all these factors that you're taking into account when you're crossing the road. You're not thinking, oh, I'm just worried about getting to the other side. No, you're worrying about all the dangers that will stop you achieving getting to the other side. Because if you're dead, you're a long time dead, and you're never going to get to the other side. So this is how you should judge the positions that you're about to take. Not where is my profit, but where will my downside be? Where are the dangers going to come from that are going to kill me, that are going to make me lose money? Because if you can take positions where those risks of losing money are at their minimum, then it's all upside. Now, this isn't just sort of a funny analogy with crossing the road. Game theory has actually worked on this problem. Now, they've worked with zero-sum games. Now, Forex is a zero-sum game, and what a zero-sum game means is that when you win, someone else loses, or when someone else loses, you win. Now, in Forex as well, we are playing a sophisticated or a better opponent. The market knows more than us as a collective, and the big banks know more than us as a collective. They can move the market, they have access to in-the-minute news, they collude with each other to push the market. So we are behind the 8 ball. We're playing a better opponent than ourselves. However, this does not mean that we cannot win. It just means that we need to play a smart game. Now, this bloke called Kevin Zolmer explains this quite well in this video that I will play now.
Time or whatever. What game theorists have figured out is that in zero-sum games, the best strategy to pursue when you're against a sophisticated opponent is to adopt the strategy which minimizes your maximum loss. This is sometimes called the mini-max strategy. So the idea is you think, what's the worst case scenario for me? What could my opponent do that would make me worse off? And then you figure out what's the best strategy against that. So you're minimizing your maximum loss. Game theorists prove that if you use this way of thinking, minimizing your maximum loss, you ensure that no matter how sophisticated your opponent is, you've guarded against the worst case scenario. And not only that, but in zero-sum games, you've done the best you can possibly do.
So he has just reiterated the points that we were just making. That the most important thing to do when playing a difficult game against a sophisticated opponent is to minimize your losses, minimize your risk. Make decisions that mean that the downside is the smallest it can be. That way, the upside will take care of itself. So you have your system, you know that you want to say, like in my live stream video, we were looking for big long runs in trends. We looked to enter those trades where we could minimize our risk. So we'd like to enter a trade at a support level where we can put our stop loss just below it, where the momentum we think has exhausted in the market and it's ready to shift the other way. The trend is in the direction that we're going in. So all these things are minimizing our downside. Now if we minimize our downside, then we just let the trade go and hopefully it goes into the upside. So while this video has not said, put up a graph and said this is where you should be placing your stop loss, or here's an indicator that's the perfect way to set a stop loss, this video is a way of encouraging you to think about your trading. Don't make your positions too big. The bigger the position, the bigger the loss, the more you have to recover. The more you have to recover, the more pressure is on your trading, the more you break your rules, the more you doubt your systems. In your systems, make sure your system, when it enters a trade, is based on minimizing the downside. Think about what's the worst case that could happen. What am I making the entry on this trade in a place where my stop loss can be as small as it possibly can? I hope this ticks over some thoughts in your brain. I'll go through some more specific ways to place your losses and to calculate risk, but first I just wanted to go through the general philosophy and thinking about risk in Forex. Thank you.